A warm welcome to all of you joining us online today for this special Credit Union Month webinar hosted by Aero Services Credit Union. I am Zarifa Haripasad, the Acting General Manager here at ASCU, and I will be your host for today's session, Building Wealth, Building Community, the ASCU Way. I must say, I am delighted to share this virtual space with you, both existing and future members of ASCU. Now, every October, credit unions around the world unite under a shared theme. And this year's global message is cooperation for a prosperous world. For us at ASCU, that message truly resonates as cooperation has been the foundation of our story since day one. Just a little bit of our history. ASCU's day one was September 28, 1950, where it all began with a small group of dedicated individuals who believed that by pooling their resources, they could achieve financial independence and security together. 75 years later, we celebrated proudly that same cooperative spirit that still drives everything we do here at ASCU. We celebrate our growth from inception in 1950, when we started with 23 members and $145 total assets, TT, to where we are today in 2025 of approximately 8,000 members and $330 million in total assets. For 75 years, ASCU has been helping members turn ambition into action, saving, borrowing, investing, and growing not just wealth, but stronger families and communities. And that is exactly what today's session is about, showing how prosperity is built through cooperation and how building wealth, building community, the ASCU way, continues to empower every member. This evening, we'll hear from our featured speaker on the importance of savings, investing, and making good financial habits from youth to retirement, followed by insights from our very own operations manager on how our products and services help members achieve that prosperity together. To all participants, please place your questions in the chat. We will try to facilitate them after each presentation. If we are unable to do so within the time frame, we would definitely be responding to you subsequently via email after today's webinar. So let's get started. It is now my honor to introduce our featured speaker, Mr. Philip Williams, MSc Finance, Leicester University. Philip Williams is the CEO and founder of Fill the Gap, PTG, a company that's passionate about working together with clients to assess their current financial situation and help them to make the most of their money. He is a graduate of Morehouse College with a BA in finance and has worked as an investment professional since 2003. Philip also gained an MSc in finance at the University of Leicester, holds the Series 6 and 26 licenses from the Financial Industry Regulatory Authority, FINRA, in the United States, and is currently the head of investment research and strategy for one of the major investment companies in Trinidad and Tobago. You can all follow him at Fill the Gap TT on Instagram and TikTok. I now hand you over to Mr. Philip Williams.
Thank you for that welcome, and hello and a warm welcome to everyone on today's webinar, Building Wealth the ASU Way. So as Zarifa said, Fill the Gap is a company that's really focused on helping you to find and fill the gaps in your financial knowledge so that you can make the best decisions with your hard-earned money. And I know there are a lot of things that you could have been doing on a Thursday evening, but I am very pleased that you've chosen to, well, really what you're doing is investing in yourself by attending today's session, which is all about saving and investing. Now, When it comes to investing, I'll say this is a question I get all the time because I'm an investment professional. Also, I, do financial planning in my personal time. But the question is, Phil, what's the best investment? And usually that is what's the best, financial product, or probably what's the best stock. And that's usually the question that I get. But let me answer that straight away for you. The best investment that you're ever going to make is the one that you make in yourself and your financial education. And I'll tell you why. So if you think about this, if you inherited a large fortune, you became a millionaire overnight, unless you know how to manage your money, you can find yourself in a situation where you're doing the most, you upgrade your lifestyle, and you end up right back where you started, wondering where did all your money go. And I'll take that a step further, right? There's a statistic from the S&P, Standard and Poor's. They rate countries all around the world to see if they're good investments. Trinidad and Tobago recently got our outlook change, and it was downgraded. So they also do research. So they do research all over the world. Basically, what S&P researchers said is 1 in 3 people is financially literate. And I'll tell you why that sticks with me, because it just means, if you're with 3 people, one of those 3 people, at least the other 2 people, they are not in a position to make smart decisions with their money. And the byproduct of that is 1 in 3 adults have more credit card debt than emergency savings. That's soaking. 2 in 5 have no money saved for retirement, right? Think about that. And according to Bloomberg, the people who actually do have retirement savings, more and more of those people are actually having to pull cash from their retirement savings to pay day-to-day bills. Now, these stats are from the US country. So think about it. This is an advanced nation where they have so much resources geared towards financial literacy and tools that are available in the palm of your hand to help, people manage their money real time. So the question they ask, well, that's not really Trinidad or Caribbean stats. And whilst I don't have definitive stats for Trinidad or the wider Caribbean, it would be very difficult for me to assert that we are any better off. No, this is not intended to make you feel any kind of way. The aim of today's webinar is to encourage you to take actionable steps so that you could find and fill those gaps in your knowledge base when it comes to your personal finances and investment education. And I would emphasize again, one of the best investments that you're ever going to make in yourself is your financial education. And that's what today's session is all about, investing in yourself, right? And your financial education. That really starts with you having a firm financial foundation with what I will call or describe the 5 pillars of PTG. PTG, just to clarify again, PTG is fill the gap. And these pillars really lay a solid foundation to help you achieve your hopes, your dreams, some of the big aspirations that you have. So just focus, I'm just going to go through the 5 pillars. We're going to focus on 2 of them today, but they're all interconnected, as you would see when I throw up the presentation. But the first pillar is really budgeting for your life, not one anyone else's. That's the first. And if you have a pen and paper, if you have a phone in your hand, you probably might want to type these out. Budgeting for your life. The second pillar is saving with a purpose, right? The third is managing your debt wisely. The fourth is setting smart financial goals. And the fifth, which everyone is always interested in, is investing to create wealth. As I said, we're going to touch on all of the pillars because they're all interconnected, but the main focus is on pillar number 2, saving with a purpose, and number 5, investing to create wealth. Chances are, as I said, you're probably here because you want to know more about investing, but I just want to clear something up. A lot of times people may be led to believe that investing is only for people who are wealthy, or you might be thinking, well, maybe, I want to hear about this, but maybe I don't really have any business taking my savings to do that. And I'm here to tell you that with the right foundation and trusted help, that's far from the truth. You actually investing can be for you. And my aim is that by the end of this session, you will have a better understanding of financial products and the stock market and how it works and how it relates to you. So I'm going to share my screen right now, and just tell me if you are able to see. Probably just put a thumbs up if you're able to see the presentation just now. Just a minute. Seeing? Can you see the presentation? Yes?
Yes, we can see the presentation.
All right, good. All right. So, and I'll tell you what. So remember I said we are talking about saving and investing today. And you're probably going to wonder, well, Phil, why are you talking about understanding that? And the reason I'm starting here is because when you are working towards saving towards something, if you really don't understand how that works, it's going to eat away at your opportunities. It's going to eat away at your options to save. So I'm touching on this just so that certain things resonate with you. And then I'm going to get into exactly how things that you can, actionable tools that you can use that if you do use it, you will see a change in terms of how you can move towards saving with a purpose. So understanding that and managing your debt is very, very critical. There's good debt and there's bad debt, right? So good debt would be anything if you are saving towards or you're taking a loan to start a business, you're taking a loan to advance yourself. And I know there are different conversations now around university and tertiary education and how useful it is, but education comes in different forms and there are different types of, there are different ways that you can learn now. So any money or any money that you are setting aside to do something like that will be considered good. I know that there's a conversation about a mortgage and taking a home and whether it's wise or not. Again, if you're working towards an asset, that's considered good debt. If you are taking a lot of debt to probably going to, every 5 years or every new car, you're buying a new car. If you're taking loans to help you, probably at the end of the month when, things are not going, probably you're not managing your finances in the best way. That kind of debt is, definitely. And this one, credit card debt, is just going to go through examples. So that's bad debt, good debt, and bad debt. So anytime you're taking debt, you have to be very, very much aware of the type of debt that you're taking. This is just an example here of a credit card calculator. If you have a credit card loan, and let's say that loan is 10%, not 10%, sorry, $10,000, and you've maxed that out. You max out this loan and you're paying the minimum balance. Really, ideally, so a credit card loan is some of the most expensive debt. It can range anywhere between 20 to 30%. And probably if you see some of those cards in Jamaica, it could be all up the way to even some of those loan predators, it could be more than 30%, up to 50%. It just depends. But this is an example of what happens if you borrow $10,000 on a credit card and you're paying the minimum balance. The difference here is really probably the one for 6 years and 1 month is roughly about, I'll say, $280 you're paying a month. And the other one, that's the big difference between $40 and $50, right? The other one that you're paying off in 13 years and 4 months and 30,000 in interest, almost 3 times. You're paying the absolute minimum balance. Now, either of these scenarios is not recommended. What is recommended is that you actually pay off. If you have a credit card, you just use it to benefit you. Use it to get the miles, use it to get points, use it to, use it for because you need USC. Use it in a way where it benefits you, but don't spend money that you don't have. So you shouldn't be taking a credit card as a loan to get something and then be paying it off like how you'd be paying a loan from the bank. That's a really, really, really bad idea. All right. I just thought that I would share that in terms of when you're if you ever taking out a mortgage, right? This is just an example of what happens. This is a 30-year mortgage at around 5.5%, let's say. And if you made an extra payment, and it could be, say, $500 every month, or it could be you make a lump sum payment. So instead of paying 12 mortgages, you end up paying 13 at the end of the year. It shaves off roughly 200,000 and it saves you almost 5 years from that 30-year mortgage. And this is actually based on an amortization schedule, which is the tool that the banks or any banker is going to use to calculate what your loan is going to cost and what the monthly payments are going to be. So this is an example of how debt works and why. The reason I'm using these examples is because it really does matter. The 50 basis points, the 0.5, the 0.25, the length of time, all of these things you have to get very granular and ask your loan officer all of the questions that you need to know. And why I'm saying this is because Any money that you're giving to the bank in extra interest is money that you can be saving towards in the credit union, saving towards a financial product, saving towards whatever the financial goal is. So just in terms of these steps, I would say if you haven't done this to date, you probably want to know exactly what debt you have, right? What is the interest rates on that? How much interest you're going to pay in total, right? You want to calculate your total debt. You want to see what your debt ratio is, and really that's really how much debt in relation to your income. Understand the interest rates, and definitely creating a budget, which we're going to get into, which is your first tool when you're really starting off to save. Your debt to income ratio, fancy term, but it really just says that you really shouldn't be passing more than 36% of your income, your gross income. So if you're earning $10,000 and you have more than 3,600 in that, you're moving into kind of a tricky space. That's probably where you should really max out when it comes to on a monthly basis in terms of what you're paying in debt. So the first pillar, budgeting for your life, which I would say is the first tool that you need to think about when you are saving, because the only way that you are going to actually know how much money that you can set aside every month is really when you write your expenses down on a piece of paper. That might sound a little ancient, like there are lots of tools, or in an Excel spreadsheet, or in an app, because I know people have lots of gadgets. You have many apps, there are free apps on your phone that you can jot down your expenses, and you'll be surprised. Now, these are things that I am telling you that I had to do. I didn't make all smart decisions when I started working. I did not make all the right decisions with my money. Um, Sometimes I might, have a savings goal or budget plan. I would hit it. Other times, so in the beginning, I was kind of winging it. I'd say, and that's what happens sometimes very early in your career. But the only way you're gonna get it together is when you determine what it is that you are saving towards. What's the purpose of saving? And if your budget is in your head, unless you are ultra disciplined and you know that you're going to pay yourself first, meaning, okay, I get paid, the first thing that I'm going to do is allocate something to my future self, savings and investing. Right, that's the 50-30-20 rule. So I'm going to take 20% and that just gone. So whatever you spend on it, it really doesn't matter. So in that case, you may not need a budget. You might just know this is the amount that I could save. If you want to get a little more aggressive and not 20%, say you probably want to save 25%, then you might have to start to itemize things. So one thing I use, it was an app. The name of the app is Expense Tracker. Anywhere you go, if you go to the bar, you go to the grocery, you go to the gym, you go wherever you go out to eat. It's very easy to track your expenses. They break it down the app breaks down, where your money is going. Because if you don't know where your money going, that is a real problem. So maybe I can probably share a tool of what something like this might look like. Before we move on, let me see if you don't, so this is a tool that I use personally. This is a tool that I share with people from time to time when I work with them. This is really your personal income statement and your personal balance sheet. So you spend a lot of time, if you have a job and you're working for a company, you're spending a lot of time building up their income statement and balance sheet. But you have to think of the business and the goals and the dreams and the aspirations that you have as big business. It's very, very serious business. So you have to think about what your personal balance sheet and your income statement looks like. This is just a tool, as I said. Some of the things may apply, but really it is your budget starts with putting down all of your expenses, whatever income you earn. It might be one form of income, that's fine. You itemize, and then you're going to know how much, was what you have. Do you have a surplus at the end of the month? Is it negative? And those are the things that actually helps you to look at, work out what your net worth is. At the end of the day, net worth sounds fancy, but really it's just what is your assets, things you may have in the bank, your retirement, things that cash, things that you can convert into cash, minus whatever liabilities, debts that you may have. So I just thought it might be useful to share that. I'll start back to share the presentation, sorry. Didn't plan to do that, but yes. So where were we? Yeah, we were here, budgeting. And that's as I said, if you don't have a budget documented, you're not giving yourself the best chance to achieve um your savings goals. You would never know if you have surplus and somebody says, well, I really just need more money. I don't have enough money to save. That might be the case, but you may never know. So some things are negotiable and some things are non-negotiable. There are things that you're going to have to do every month that, I have to do this, I have to pay the light bills, but there are things that may be non-negotiable, which I wouldn't tell you what that is because that's a personal decision. I'm very careful with that. But you need to figure that out and what kind of sacrifices or adjustments that you need to make. And a budget will help you do that. One of the tools I also use to help you or help me, and people that I work with save with a purpose. If you have a savings goal and you said to yourself, and again, all of these things, I'm telling you, these are things that I had to do. Things that I wish I knew in my 20s. I only started doing it in my 30s. And it doesn't matter if you're past 30 or in your 30s or you're past 40, it doesn't matter. If you don't have the time to write down a goal, then you have to question how much it really means to you. Now, if you have a goal and you said, listen, let's say we're thinking let's say it's January 1, 2026, and you just decide, you know what, okay, the year is almost done with 2026. I'm positioning myself to save more. That's a great goal. But when you set in a goal, you have to be very specific, right? It should be smart, right? It should be measurable, should be something that you could achieve, something that's very realistic and time bound. So if you said, listen, I am going to save $1,000 every month, so from January 1st, so that by December 31st, 2026, I'll have $12,000, and I'm going to take that money and, I don't know, start investing on the stock market, put it towards, or I might just save that money, that $1,000 in the credit union, or save that money in a financial instrument. That's very clear. Once you write down a goal like that, then it starts to take form. It starts to it's framed in your mind. I know there's a proper way to set up financial goals. This is the first part of the sheet, but I want you to think about that. If this goal really matters to you, then you're gonna ask yourself, well, what are the things that you're gonna gain? How am I really gonna feel? Now, you might say, well, if I'll feel good, I'll have more money. That is true. What also is true is that you have to think about really psychologically, how are you gonna feel? Who are the other people that are going to be impacted? Am I going to feel, a little bit more confident about my personal finances and my money journey? Am I going to feel a sense of accomplishment on a monthly basis, knowing that, actually I do have what it takes to keep pushing towards this goal and I'm seeing myself getting closer to this goal? What does that do for me? How do I feel? And this goal, what does this goal really mean to me? So all of the benefits, all of the things that going to come out of this savings goal, you want to write that down. And then think about what happens if you don't achieve the goal. And you also want to think about the things that can stop you. Some of the things that can stop you, probably not communicating to people who are involved in your life or who may be around you. It may be friends, it may be a spouse, it may be a partner, it may be a boyfriend, a girlfriend, it may be, listen, I am taking steps to cut back on certain things. That's maybe a conversation you may need to have. I am going to, I don't really track my expenses. I'm probably going to try and get a spreadsheet. I'm going to download an app. What are the actionable things that you're going to do? What are the things that could hinder you and how you can overcome those things? So this is just, usually when I do this, this is a goal planning session as a whole session because this is just the front of the sheet. But I want you to think about how important are your financial goals to you. So when I started writing on my goals, that's when, now you're not going to hit all your goals there, but I promise you, a sure bet, you start writing all your goals, you're giving yourself far greater shot of achieving that goal than someone than not doing it and everybody else who is not doing it. And the thing about it is if you fall off or you miss 1 month, you're budgeting whatever the savings goal is, this is something that's going to keep you on track, right? This is something that's going to keep you on track. It's something that's going to, because you're going to write down dates for when you're going to do certain things. If let's just say a one actionable item after this session might be like, boy, I'm going to download an expense tracker. That's why, yeah, today's the 23rd of October, yes, right? So you're gonna if if that's actionable and you know that that's the date that you put down. If you've seen that, chances are you're gonna do it before midnight. And if you didn't, and the goal is in front of you, you're probably going to do it first thing tomorrow morning. So I just want to reiterate the importance of writing down your goals because that is crucial. So on to the part that's everybody's going to be very excited about. I said, let me get, lay the foundation because before you start investing, sometimes too, it may be the right time to invest. It may not be the right time to invest. And also it depends on what your risk tolerance is. It depends on what you can be investing in. This is plain vanilla traditional stocks, bonds, and mutual funds. I'm going to go through what those things are and give you an idea of what is available in the market and how you can get started. So a stock really, there are two forms of raising capital. Same way a company can borrow money, or they can say, you know what, I'm going to give up a portion of this company, sell some of it to investors, and I get capital to expand and do some of the things. So I have to give up some control. So a stock is issued by a corporation to raise funds, to generate funds to, for the business to expand, whether that is to buy a new building, whether it is to go into a new territory, whether it is to buy more equipment, it depends. But a stock is really a form of raising capital. And when you invest in a stock, whatever the company is, you are a part owner, so it's a fraction. A mutual fund, and I'll get into, so there's stocks on our local stock market, there are local stocks and there are international stocks. But before we get into that, mutual fund, think of a basket of, it's pooled together. So think of all of us here on this call, this webinar, pooling our money together, and a fund manager manages it. You pay the fund manager a minimal fee, and whatever those instruments that is in that basket, whether it's stocks, whether it's bonds and stocks, the returns are then passed on. So a mutual fund, there are different types of mutual funds, right? Which I will explain. So there's some that are risky in terms of the types of returns that you can get are higher, and there's some that are very conservative. You're looking just for a stable return. A bond, it's a fancy word for a gigantic loan. Corporations borrow money. Governments borrow money. So the government of Trinidad and Tobago borrows money, whether it is to pay salaries, to pave roads, to do whatever. A bond is a contractual agreement. It's safer than a stock because stocks are not guaranteed. The company is not guaranteed to generate profits and pay out dividends, which is a share in the profits. But this is a contractual agreement where I don't know if some of you may or may not have heard in the budget, they spoke about the NIF bond. And you may have heard that because this is another tranche that's coming, but it's a bond that's going to be issued by an entity that's owned by the government or assets that the government owns, and the returns are passed on to investors. So a bond is just a fancy word for a gigantic loan with specific terms for when interest is to be paid, when the money that's being borrowed, which is the principal, when that's going to be paid back, and what is the interest payment, which is the coupon. How the stock market works. So a company wants to raise money, they decide to sell part of their shares. The shares are sold on the stock market, and people in the stock market, so it's available to the public because some companies are not listed on the stock exchange. So they're private companies that do well with just only privates, and those are closed investments. But once a company is listed on an exchange, like our Trinidad and Tobago Stock Exchange, and I'll show you the examples of some of the companies that are available, you are a part owner in these companies. So that's in a nutshell how the stock market works. Companies come, they're looking for capital, investors and people who want, and they say, listen, this is a good investment, I'm going to invest. And the company, once it does well, they pass on profits to, and there are two ways that you can get profits: through dividends, which is a share of the profits. The other is capital appreciation, meaning that the company is doing so well, people are just wanting to buy up the shares and it pushes the price up. All right. These are some of the companies that are listed on our stock exchange. I'm sure you've purchased some item or items from one of these things that are on the screen. The reason I'm putting this here is really just to remind you, you don't have to be just a consumer, you can be an investor. If you have a loan, anybody has a loan with any one of these banks, then the interest that you pay on that loan, these banks pay hundreds of millions, sometimes billions, in revenue and profit generated. You can be a shareholder because these companies are listed on the stock exchange. As I said, some of the things, if you're drinking alcohol, Sanga store, if you're shopping in the grocery, there's massive. If you're buying cars from Answer, that's, if you just depends. You're building a house, you're eating KFC, all of these companies are listed on the stock exchange. And you have an opportunity to participate, not just by being a consumer, but by being an investor. And I'll explain to you how that could be done. To buy stocks, you need to open a brokerage account. There are 8 brokers. Think of a brokerage account like a bank account. You're going to put money in the account, but just in this case, you're going to tell the broker, well, listen, buy some Republic Bank shares for me, or buy some Massey shares, or buy some First Citizen shares. You basically give them instructions, sometimes over the telephone, sometimes via an email. But that's really how it is. You open it, you put money in, the brokerage, the fee, there's a brokerage fee, which is called commissions. And if, let's say, you invested, the trade costs $100, the cost to purchase shares could be a dollar, or $1.20, somewhere thereabouts. So that's the commissions fee, right? Like anywhere between 1 to 1.2%. But sounds fancy, but that's what a brokerage account is. Like it's an account, same know your customer stuff, and you have to give them the information you need. But you're going to put money in this account. And some of the same banks that you may have loans with do provide brokerage services. I can show you the list of brokers here, but before, I know a lot of times people say, well, boy, all right, so I want to invest on the stock market. I want to invest on the stock market. Just want to start today. And there's nothing wrong with that. Today may not be the day. If you have high credit card debt, the answer to that is yes. Today may not be that day, because the first thing you want to be doing is reducing that debt. If you don't have any money saved for an emergency, so if the answer is no, you don't have an emergency fund, you might want to start saving some funds. An emergency fund typically is anyway 4 to 6 months of your expenses set aside. It doesn't have to be your gross income, but whatever your expenses are. And if you're very, very risk averse, meaning that you're real scared, if you invest $1 and it's 99 cents tomorrow, 95 cents next week, and you're scared and you can't sleep, you may need to rethink that. But I would say that there's risk in not taking risk, especially if you're a young person. There's risk in not taking risk, because in not taking risk and positioning your money appropriately to get the best type of return is putting yourself at a disadvantage, so that you, because some of the goals you may have are very big, and you want to give yourself the best shot to push towards those goals. And sometimes, more often or not, it is a mutual fund that is invested in stocks, or it is directly stocks on the, or combination of stocks on the stock market. So just to rewind, a mutual fund that I was going through before can either have stocks, bonds, or combination. If it's a balanced fund, it can have stocks and bonds to get the best of both worlds, depending on the type of investor. These are the list of brokers here. So you will see Boss, Republic Bank, Shepherd, GMMB, NCB Merchant Bank, Wise, which is RBC, and First Citizens. These are your brokers here. And so some of them, so like GMMB, which is not an advertisement, by the way, but I'm just, because a lot of times the first question is, well, how much it is to open a brokerage account? 2,500 with GMMB, 2,500 with NCB Merchant Bank. Some of them are a lot higher than that, but those are the two that I would say are on the lower end. In some instances, when there's an IPO, meaning an initial public offering, so companies now come into the stock market and it's the first time they put in shares, that's a new offering or initial public offering. I've seen instances where the lead broker meaning anyone, because they need a broker to get the stocks on the stock market, might say, listen, you can open an account with as little as $1. So it depends. Getting started, I just wanted to give an idea of the stock market. The stock market, it fluctuates, so it goes up and down. So what you're seeing here is some years when they're green, some years when it's kind of yellow. So it just depends. But on average, the general trajectory of the stock market is up, right? This is over a number of years. So the market, it can be choppy, but generally it moves up. That's what I want to leave with you. It moves up. So even though, and why I mention or reference sometimes for a younger person to be more aggressive, doesn't mean if you're older that you can't invest in stocks, but as you start to approach, you're more seasoned and you're starting to approach retirement, that's when you want to be conserving, right? So a good rule is, let's say if you're a 20-year-old person, you have $1 to invest, 20 cents of that dollar should go into like a fixed income or bond or fixed income or safe investment, and 80 cents into a mutual fund that is invested in stocks or directly in the stock market, because you're very young and you have time on your side to deal with the fluctuation. If you're 30, you want to split it 70, 30. If you're 40, 40, 60, 50, as I said, as you approach retirement, you're more shifting towards just much more safer investments because you don't have the time to take on that kind of risk. This is not again not an advertisement, but this is just an example of what Republic Bank's return has been. By the way, they push out almost $2 billion in the billions of dollars in profits. They sell a lot of loans. This has been their return over 30 years. I just use this as an example, and it is not a recommendation to go and buy Republic Bank stocks. It is an example of the type of returns with more, and it's one of the more blue chip, I would say, one of the larger companies, stable companies on our local stock market. So I just use this as an example. What I want to leave you with is, if you think of this, right? Time is very, very, very important. This is someone starting at 30 and they were investing $1,000 every month. And so they say they did it for 20 years, right? So at 50 and the rate of return was around 8%. I use 8% because the return on the stock market could be anywhere between 7 to 9%. So I went middle of the road. At the end, they're, in terms of ending balance, it's around 600,000. The contributions are 240,000, and the interest or the interest and capital appreciation is 360,000, right? But think about this: if the person was 30 years old, really, there's a huge difference here, and the difference is just time. Faster you start investing, the better it is for you. So 600,000 versus 1.1 million, that's a very, very, very big difference. Again, these are just numbers and ages. It doesn't mean that if it didn't start at 20, the world is ending. It doesn't. Usually a 20-year-old doesn't have as much money as someone who's working at 30 and 40. Earning capacity is greater, so you can actually contribute more. So it may not be 1,000, it might be more than that. One example I would use here is just to be careful, just to remind you about debt. And when you're purchasing certain items, it doesn't have to be a car, but it's important to stay within your financial lane. So this is a car, $200,000 car versus a $300,000 car, what the monthly payment would be. And the monthly payment on one is 3.5 and the other one is 5.2. So there's a difference of roughly 1,700. But think about if you invested 1,700 for 5 years in the stock market or in a mutual fund that's giving you a decent return for 10 years. The reason I'm using 10 years is because a lot of times people just, they say, well, it's 5 years, boy, I feel my car get old, I need another car. Again, that's a personal decision. I'm not going to tell you when you should and shouldn't buy a car, but those things should be aligned to the types of goals that you're working for. So if you're going to sacrifice and say, boy, you know what, actually car working real good, I might keep it. That can help you, right? But again, that's a personal decision. So this is just a simulation of what 1,700 could look in over 30 years. That's 2.6 million in 20 years, 1 million, 10 years. So just food for thought when you're making purchasing decisions and long-term, there are long-term consequences. And again, I can tell you this isn't when I drove a particular vehicle, a truck. I had the truck for 17 years. And some might say, well, Phil, that's very boring. I get it. So what I say is, but I'm just sharing with you a personal experience. But I took the truck, I got it from a credit union. The payment was 3,800. And I said, boy, you know what, maybe I shouldn't let lifestyle creep get involved here. So when I paid off it in 5 years, I took that 3,800 and just started to invest it. I kept the truck. And as I said, I've had it for 17 years. That allowed me to do a lot of things. But again, that's personal. I figured I would share that with you. My personal experience on making sacrifices, making decisions that are aligned to what you want, the things you want. And sometimes the things you want is not just for you, but it's for the people that you care about around you. Right? And I think that is it. I'm going to stop sharing. I hope I have enough time for questions, as I do. So when I started the session, there were like 20-something people there, almost 60. I am seeing, good afternoon, everyone. Feel free
We
to
have
leave.
59 members now.
Okay. Well, I'm not seeing any questions in the chat. So that means either, I wouldn't say what that means.
Phil, I think it probably means that you would have explained thoroughly
I
and
doubt.
well detailed.
I doubt. Everybody always has some question, I'm sure. So either you're very shy, but you could type. So it's not, you don't have to put on your camera.
Mhm.
And you don't have to speak in the mic. But if there are questions, you can type them in the chat. I have a little more time. And if there's something that you probably still want to ask in the chat here, you can probably direct it to a member on the panel that they may be able to get it to me. Thank you for your presentation. You reinforced and introduced to me new concepts. Thank you. Is it Yallery? Yes. You're welcome. I'm glad to hear that. The explanation was very thorough for me. Candice Richards. Thank you, Candice. And if, as I said, if there are things, you can either get them to me via email or you can send me a direct message on Instagram. If you don't follow Fill the Gap, you should follow. I speak about these things, if not every day, every other day, if not that, every week. I do my best to give you the information in a palatable way, that things are concepts that might be complicated, to help you make the best decisions that you can make. So good work, sir. I follow your work, especially on IG. Keep up the good work. All right. Yes, Ryan, I appreciate you, my brother. Thank you very much. Yes, I do still have an investment course going. That was the video that was going to come up, but I didn't want to do any advertisement on the Aero Services Credit Union webinar. But I do have a course. Yes, I do. How good treasury bill bonds from? That's a very safe and good question. That's a very safe investment. Good place to park your money if you're thinking about the short term. So it's a safe and a steady investment because you get a fixed return, right? So yeah. But just remember with treasury bills, again, it's not, you're not, I would say it's not long term. It's more geared towards a short term goal or just preservation of capital. And it's also good for someone who's heading either at retirement or close to retirement. If you have credit card, thanks, Phil. Hold on. Just now. Thanks, Phil. I'm retired, unfortunately, say, but I have done much better using some of your tips. Okay. All right, Joe. Thanks. If you have credit card debt and you have savings to cover it, what are your thoughts? Very good question. So a lot of times, just make sure, because I know I know the psychological feeling of, well, my bank balance looks like this, and if I use it to pay credit card debts. But what I would tell you is, make sure once you have enough for emergency and you have savings to do, then you should. I'm not saying to wipe out your savings to pay down credit card debt, but the money that you're going to be paying in interest, if you're just paying the minimum balance, it's really like you're giving up savings, if that makes sense. So be as aggressive as you can be. Use a budgeting tool or something that's tracking your expenses, see how much extra you can contribute. If you can't wipe it off all at once, take steps to just make bigger payments towards it and just get out of it. Don't let it don't let it don't pay the minimum balance and let it drag on. Really, in the presentation, you spoke about a certain percentage of your income that you should either, it's 36%. So essentially, if you have $10,000 and your debt is at $5,000 or $4,000, you're stepping into a territory where that's a bit tricky. And actually, the banks look at that, right? And the credit union, when before they give you a loan, they're gonna assess how much debt you have to determine either A, if they're gonna give you a loan, or B, what's that loan gonna cost. And the more debt you have, the riskier you appear as a client, the riskier you appear. It just gives the notion that you are likely or more likely than someone else who has less debt to not pay a loan. That may not be the case, but that's just the maths that financial institutions have to run to protect everybody else, to protect themselves and everybody else. So try to keep your debt within a certain limit. Will you be able to explain? the advantages of, so a treasury bill is a short-term debt instrument issued by the government. So it's like government debt, and it's a safe investment. It's the opposite of like a stock, whereas it's a guaranteed return. And whereas a stock returns, your earning potential is greater, but stocks fluctuate more with the economy. So when the economy is doing great, you find the stock market does great or is supposed to do great, and the returns are higher. But if not, the bond market or fixed income market or treasury market will do a lot better. So that's why sometimes investors take a more balanced approach. Some people who are more measured, moderate, people who are ultra conservative will have all their money in treasuries. But if you have long-term goals, that's not where you want to be. Do some banks automatically take the credit card interest from the balance every month, so you only have the principal to pay? I'm not sure, but I know what they will do with a credit card is it's up to you. You can pay it off all at once, or you pay. And really, when you're paying the minimum balance, you're really paying interest on interest, because of how credit cards work. You really sometimes, a lot of times, you're not paying on the principal, whatever the amount you borrowed, and you find yourself just paying interest. What is the recommended contribution for retirement savings if you're in your 50s? Should you contribute? Yes. So your contribution should be as high as it could be. You probably want to be as aggressive in terms of your contribution, not aggressive in terms of the type of investment. So you don't want to take all your money and put it in the stock market, but you want to be aggressive in terms of the amount. Do as much as you can do, because remember, your paychecks are finite. You only have a certain amount of paychecks to get to where you want to go. Once those paychecks are done, then you've missed the opportunity. So every time you get paid, every time you get a bonus, it's an opportunity to get one step closer to the financial goals and the things that you're working towards. So put as much as you can. Work out what is the sweet spot. I'm not telling you to live a boring life, but work out what's the sweet spot in terms of what you can contribute. And if you can contribute more, contribute as much as you can, because you don't have as many salaries as someone who is 20 or 30 or 40. All right. It is, I think I'm over my time, and I would love to stay, but I have another engagement, so I'm not running away. I'm not being rude. I have to come off the call, and I just want to leave you with some words just to say, you do have what it takes to take charge of your financial journey. Some things may seem daunting, but a lot of times you might be doing better than you actually are. And take this session to heart. Take the things that I've said. If you're really serious about getting your personal finances together, you want to get, some tools to help you. So as I said, get your numbers down on a spreadsheet or on an app or something, and start writing down your goals, and you can take charge of your financial journey. I want you to know that. I want you to believe that. And those tools are what are going to eliminate and remove all the doubt. Those tools are things that are going to help you feel very, very confident about pressing towards the things that you're working towards. Sarifa and the
Yeah.
entire Aero Services team, Adana, everybody, if I'm missing anybody's names, I'm sorry, but thank you for having me. For everybody who attended today, I'm glad that that the session, you did get some value out of it, and take care of yourself. All right. Bye-bye, everybody.
Well, thank you very much. Let's take a leave, and very informative, very practical, and some easy steps, things we could relate to. So thank you very much from Aero Services and from our participants as well. We appreciate it.
You're
And all the
welcome.
best.
Thank you so much. Enjoy the rest of the session. All the best in the rest of the session. Bye-bye.
Thank you. Take care.
Take care.
Bye.
Bye.
All right, guys. So, Phil's presentation was quite informative. He identified some important pillars, and a lot of these things are quite relatable and easy for us to implement. It shows how small, consistent actions could actually benefit us in the long term and lead to long-term prosperity. I know some of us familiar with Excel, so that for one definitely is a easy to do. So you guys can feel free to follow him on social media at FillTheGapTT. You can email him at admin@fillthegap.co. Right? Now we would move on we will now look at how these principles translate into real benefits for our members. And we will hear from one of our very own, who ensures that the spirit of cooperation and member success stays at the heart of everything we do. Please join me in welcoming our operations manager, Ms. Anne McPherson, who will share how Aero Services Credit Union can empower you through our services and opportunities designed to help every member build wealth and build community. Let's welcome Ms. McPherson to the virtual stage.
So good afternoon, everybody, in the webinar. Good evening. Thank you, Zarifa. So we would have just heard from Phil in terms of savings and investments. And there's another side to the coin in terms of borrowing and actually growing your wealth while you are borrowing. So I'm going to share a slide with you as we go through what is a credit union, what the credit union can do for you, the products and services that we offer, and that could enrich your lives. All right. So a credit union is a non-profit organization, and it is controlled and owned by its members. There's a board of directors that is elected at the annual general meetings, and the officers of the credit union are actually volunteers to the credit union. Credit unions realize surplus at the end of the financial year, and this surplus is divided and returned to its members in the form of dividends, cashback on your loan interest, reduced fees, and lower borrowing interest rates. The dividends and cashback can be used to be placed on your shares, which will grow, and the following year you will actually get more dividends and more cashback once you take loans to help increase your wealth. Aero Services Credit Union does not only offer loans, we accept deposits, shares, investments, and we provide other financial services. We are in the business of promoting the well-being of our members. We have several loan products available to our members. We have personal loans, which is pegged to your savings, your shares, at very low interest rates, which means that you can borrow your own money, pay back a small interest, and still get dividends and loan interest rebate on those loans. We have revolving loans. We have unsecured loans up to 3.1% of your share contribution. We have investment loans. We have vehicle loans, and we have mortgage lending. And we know that our mortgage lending is an asset, and as Phil would have said, that is what we call good debts. Along with all the other aspects of our loan products, it has to be used for good purpose. So when you borrow, you're borrowing to grow yourself, grow your family, and you are also saving. One of the aspects of Aero Services Credit Union loans is that there's a savings element involved, which means that when you have a loan, there is the criteria that you must place money on your shares. So by the time you do finish pay off a loan, you have a very big increased savings in the credit union. There are products that the credit union also offer in terms of insurances. We have health insurance, we have critical illness insurance, and we have the family indemnity plan. One of the things I always recommend to our members and potential members is the family indemnity plan, which assists members in terms of death in your family. That is something that it happens, and you don't want to be scrambling to have to pay the funeral home or to do anything where that is concerned. So that is one of the products that we do offer that I highly recommend that each and every member or prospective member takes when they enter into the credit union. We did a lot on savings and investments. Aero Services has a fixed deposit, and it's a secure investment offer that ranges from 1% to 4%. with deposits starting as low as $5,000. All right, the fixed deposit rates are fixed. It is very good compared to market rates. Members have the opportunity also to use their fixed deposits as collateral on a one-to-one basis, and they have all the benefits of getting the interest. Either you can get it quarterly, semi-annually, or annually, or upon maturity, which we do recommend upon maturity. All right. One of the things that we would like to let members know and prospective members is that when this is that you are applying for any loan, there is the need to have a job letter, payslip, 2 forms of ID, a recent utility bill, and basically the loan purpose. For our 75th anniversary, we have 100 days of Christmas going, where you can borrow $45,000, $75,000, or $100,000. Now, this has the savings aspect in it, where it is that, let's say you take a $45,000, $15,000 of that goes onto your shares. And that shares is also going to be have dividend aspected at the end of the year. So next year, when AGM, that $15,000 that you would have put on the shares will get a dividend payment on it. And you will have your $30,000 cash in hand. All right, so Zarifa, back to you.
All right. Thank you very much, Anne. Thank you for the information. I saw that we had a question in the chat where Ms. Yari asked, which category does the PESH loan fall? As Anne would have mentioned, that is our current loan promotion, the 100 Days of Christmas. So the PESH loan is the loan that has the component of both the savings and the borrowing aspect, cash in hand aspect.
Correct.
Right. Are there any more questions for Anne? Anne, you can tell us a little bit in terms of, if you probably share for those, because we have some prospective persons online, persons who are new to Aero, and hopefully we'll be seeing them again. So if you could just probably share with them how to join, how to be join the Aero family.
Okay, so to join the Aero family, you can go online where there is the membership form. You can fill out the information, and what you would have to supply to Aero Services is a job letter, recent job letter, no more than 6 months, a recent payslip, no more than a month, 2 forms of PITIA ID. If you do not have your ID, you can use a PITIA ID and your birth paper. You have recent utility bill, no older than 3 months. And if it is that the utility bill is not in your name, what you can do is have say you're renting, you can have the landlord write a letter giving you permission to use the utility bill along with a copy of their ID. And you fill out the membership form and you join the credit union. There is a minimum fee of $50, which 20 of that becomes shares. So you automatically have shares when it is that you come into the credit union.
Great. Thank you. So I hope we will be getting an influx of applications after this. With regard to, and just to share with some, because I know if persons join one of the, and of course with regard to credit unions, we offer credit. One of the things we may be wondering would be how soon after could somebody, after joining, could I access a loan?
As soon as you join, you can access a loan. We have the Jumpstart loan, which is for new persons borrowing. So let's say a young person is now starting off. We have a Jumpstart loan of, let's say, $20,000, and 10 will be in hand. So you break, as usual, we look at savings. So you have that $10,000 in hand for savings, and you get $10,000 in cash. All right. So as soon as you join, you can do that. There are also loans and promotions that we have. We have things like the Notting Down vehicle loan sale, which we have coming up again on the 14th of November, where it is you have same day membership and you can apply for the loan on the same day.
Great. So one of the things I wanted to wanted us to share now, as you mentioned, because Phil also would have mentioned in terms of the percentages when it speaks to a person's income and so on, your monthly income, your percentage, how much you should save. Now, and you also mentioned banks look at a particular percentage of your income. How do we, if you can share with persons, what is our requirement? How do we put that into play? How do we apply that? So when we're applying for loans, what we look at.
Okay, so what we look at is the norm, which also the banks, so we look at your debt service ratio. Debt service ratio, a good debt service ratio is normally 40%, which means that only 40% of your funds or your nets or your gross salary is encumbered. With credit unions, because we are members and we are owners of the credit union, what normally happens is that we look at your payment patterns. We look at the 7 C's of borrowing. And we will look, okay, you might go to 45%, you might go to 47%. The credit unions are normally a lot more, I would want to say lenient, but a lot more, we are lenient in terms of our members, where it is that we try to grow the members and we work with the members in terms of getting loans. It's not a hard and fast. Yes, we have to do what is best practice, but we tend to work with our members more than with other financial institutions. Well, I don't want to say banks, but banks.
Okay, and thank you. And I'm glad you actually raised the point with regard to the members being the owners of the credit union, because as you would have mentioned before as well, and I wanted to share to reiterate, is that for those who may not be familiar with the concept of it, just as you said, the members of the credit union are the owners of the credit union.
Right.
We are the ones who all the surplus returns to, whereas with other institutions, if you're a shareholder, you're not necessarily the one who taking the loans or so on. So if you're a customer of another institution, you don't necessarily get the profit or surplus returning to you. But in a credit union, as one differentiating factor, and me having come into the credit union realm, I've appreciated that a lot, because you feel a sense of ownership, sense of community. And that holds true to our theme today, building wealth and building community, the ASCU way.
Correct. Just to add to that, Sarifa, in the credit union itself, as I said, there's a savings pattern where it says that even though you are borrowing, we always encourage the saving aspect of it. And the mere fact that the profits that are made are distributed to the members, you can actually grow your wealth, grow your shares with the amounts that you would have taken, you would have borrowed. So say, for instance, and I would like to say that last year, 4% was declared on as a dividend. Persons would have gotten those funds in their account a few days after the AGM. And a lot of persons will transfer that said money that they would have earned and put it back to their shares, which will now earn more in the following year. When we look at I want to say banks and other institutions, we don't get parts of the profits. We don't get much interest rates at all. I'm sure nobody on board here can tell me they would have gotten any interest on their savings account or their bank account. And if it is that they do, it's 0.0001. So in terms of the credit union, that saving aspect and the growing of wealth and growing of your portfolio, the credit union definitely encourages that to its members.
Great. Thank you, Anne. And to persons, if you have any questions, please feel free to post it in the chat. If not, we'll also accept any questions after the webinar. You can get in touch with us. Sorry. You can connect with Aero Services in any way convenient to you. Our branches, we have 2 branches. We have our Trinidad branch is opposite Etihad grounds here in Tacarigua. And we also have a Tobago branch at Barrington Courts, Milford Road, Tobago. You could call us at 640-6416 for Trinidad office or 363-7298 for our Tobago office. You can visit our website, www.aeroservicescu.com. And for those of you on social media, much like me, I get all my info from social, may not be safe, but you could connect with us on social media, Aero Services Credit Union, and visit us on Facebook, Instagram, LinkedIn, YouTube. Visit us, follow, like the page, keep up to date with all that we have to offer. And I want to thank you again for your presentation and showing how Aero Services continues to live its motto of enriching the quality of the lives of our members.
Thank you,
Right?
Zarifa.
So I'm not seeing any more questions in the chat, so I will move to close our session today. So as we bring today's session to a close, we just reflect on a few key points. Prosperity is built through cooperation. Through Aero's strength lies in our people, our members, our officers, our staff, and our shared purpose of enriching the quality of our members' lives. Now, building wealth, building community, the ASCU way means that every deposit, every loan that you partake in with the credit union or in a credit union, is every act of participation helps another member succeed. Because when you deposit with the credit union, those funds are lent to persons who are in need of credit. And then those persons who take the credit, they pay the interest, it's returned to the credit union in terms of surplus, and the surplus is shared amongst all members. True sense of community, right? So we believe that we can live this year's International Credit Union theme of cooperation for a prosperous world together if we continue to live the spirit of cooperation and create a prosperous future for every ASCU member and every family, as we would have mentioned before. So if you're already a member, please feel free to explore every opportunity your credit union offers to you. And if you're not yet part of the Aero family, we invite you to join us and experience a cooperative credit union that works for you and with you in enriching the quality of your life. You can check your emails after the session for more information on what we would have discussed today. So thank you to our presenters again, and to you, our participants, for generously spending your Thursday evening with us. And on behalf of Aero Services Credit Union, happy Credit Union Month, and cheers to 75 years of building wealth and building community the ASCU way. Have a good night, everyone.